A tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero. Hello and welcome to the Power of Zero show. This is your host, best-selling author David McKnight, author of The Power of Zero, Look Before You Lurk, The Volatility Shield, and Tax-Free Income for Life. If you are looking for someone to help you navigate all of the pitfalls that stand between you and the 0% tax bracket, head on over to davidmcknight.com. Happy to hook you up with a member of our elite POZ advisor group, among the very best financial advisors in the nation, particularly within the tax-free Power of Zero worldview. They've been trained, vetted, qualified personally by me. If you are an advisor looking to level up your game and transition your practice to a Power of Zero worldview, you can head over to powerzero.com, opt into the 3-part video series, and we would be happy to schedule a phone call with you to discuss further. If you would like to follow me on Twitter, please do so. It's @McKnight&Co, @McKnight&Co. You can also follow me on Instagram. It's David C. McKnight, David C. McKnight. And as always, we would love a review of our movie, The Power of Zero Tax. The tax trade is coming. You can stream that anywhere you stream movies. We would love reviews on any of our books or on our podcast as well. Appreciate all of your support. Okay, so today we are going to be discussing the question that may be on a lot of your minds, and it's simply this: is inflation here to stay? And I'm going to be drawing on a couple of articles today, and I'm going to give you the Power of Zero spin here at the end. But I think these articles are very instructive. Both of these articles do concur in so much that they believe that inflation is here to stay. The first article I'm going to be referencing is going to sort of lay down what the basic supply and demand issues are that we're facing. That's an article from pbs.org. And then there's another article where we draw from the thoughts of a hedge fund manager by the name of Paul Tudor Jones. That's from CNBC, where he discusses why he feels like inflation is here to stay. Well, let's jump in first of all into the PBS article. It begins by saying consumer prices soared in October 2021 and are now up 6.2% from a year earlier, higher than most economists' estimates and the fastest increase in more than 3 decades. So really, we've grown accustomed to inflation over the last 20 years that has averaged about 2% per year. That's what the Federal Reserve pegs inflation at. That means that's their target. That's what they're really going for. And what this article tells us is that 6.2% is a dramatic departure from what we have experienced historically. We've been lulled into this idea that 2% is normal. It's average. So 6.2% is a 300% increase over what we're accustomed to seeing. Article continues, one of the big debates going on right now among economists, government officials like Treasury Secretary Janet Yellen and other observers is whether these soaring costs are transitory or permanent. In other words, is inflation short-term or is it going to be around for the long term? Is this something that we need to get used to? Article continues, there's been a growing chorus of economists, strategists, and business executives sounding the alarm that high inflation will likely be with us well into 2022 and beyond. So let's take a look at the principal factors that are driving inflation. We know that inflation is primarily a question of supply and demand, and that's really what's driving things at this point. So let's talk about demand. The reason prices are rising are complex and many, but one of the most important relates to the dynamic of supply and demand, and both are to blame. So let's start with demand. So the article says that even though early in the pandemic, consumer demand dropped as people hunkered down amid lockdowns and unemployment skyrocketed, it has soared over the past year, not for services like restaurants and travels, but for goods mostly ordered online. E-commerce activity has simply mushroomed to levels that never existed before the pandemic. Demand for products has significantly outstripped the market's capacity to produce or ship what is ordered. Some people aren't even going to the supermarket, hardware store, or restaurants anymore because they do all their ordering online. And folks, I think this is something that we all grew accustomed to doing. I mean, you probably saw this firsthand during the COVID pandemic. You didn't do any of your shopping in stores. Most of our shopping happened online. Even grocery stores were receiving their orders online. And so we sort of grew accustomed to ordering online and we didn't really snap out of it. We got so habituated to ordering things online that we didn't shift back to the pre-pandemic mode. And so this custom of ordering things online, I think, is here to stay. The article continues. E-commerce activity has simply mushroomed to levels that never existed before the pandemic. Demand for products has significantly outstripped the market's capacity to produce or ship what is ordered. Some people aren't even going to the supermarket, hardware store, or restaurants anymore because they do all their ordering online. Many retailers such as Macy's, Target, and others have had to navigate this economy with scarce inventories and higher freight costs to stay alive during the pandemic. We've seen instances where it might cost $2,000 to ship a container from China to the U.S. That cost has increased 15-fold in some cases. We've seen the cost of shipping that container go up to $30,000. And of course, companies have to hit their profit target, so they simply pass these additional expenses on to us, the consumer. It says these trends have created more demand than the delivery carriers can accommodate, stretching their ability to deliver products. Now, this is a key point. I want you to focus in on this. Given there is great difficulty finding drivers, containers, and labor across industries, big retailers are offering generous education and other benefits to both attract and keep employees on hand as a means of adding capacity. And folks, how are they going to manage all of these increased expenses, all of this increased costs of hiring the right types of people? Or they're going to pass it on to consumers. Okay, so those are all of the unintended consequences of the increased demand. Now, the other side of the ledger is that we know supply is down. So you have increased supply, and then you have increased demand, and you have reduced supply. This is an absolute perfect formula for increased inflation over time. It says that at the same time, supply chains remain a mess and are only getting worse. Bottlenecks have piled up all across Asia, putting great strains on the capacity of supply chains to deliver in a timely fashion. And so severe global shortages of drivers and other workers are making it difficult to expand capacity or fix other problems plaguing the supply chain. So they can't break free of the thick mud they're in. This creates a shortage of products, getting through that limit competition, causing price increases. And so this is where we get into the actual real life scenario, the real life details of what we're facing with this supply chain disruption. It talks about how there are dozens of huge container ships that are idling near the ports of Los Angeles, New York, and elsewhere around the world, which of course ties up large quantities of merchandise that's waiting to be unloaded. There are over 500,000 shipping containers with about 12 million metric tons of goods near Southern California alone. I've got a friend here in Puerto Rico who sells shoe inserts, and his business is basically almost screeched to a halt. It's been impacted in a pretty severe way, given that all of his inventory is sort of stranded in these container ships off the coasts of these ports. So this is real life stuff. It's affecting people in a real life way. And the cost of all of this is going to be passed on to you, the consumer, in the form of higher prices. And then it gives us an example of Nike. It says Nike depends on Vietnam for much of its shoe production. It lost 10 weeks of production because of lockdowns within that country. And it's taken an average of 80 days to get shoes from Asia to retailers in North America, twice as long as it took prior to the pandemic. And so what's the obvious result of this? Well, they're passing their costs of soaring prices on to us, the consumer. So the cost of shoes are going up, costs of goods are going up, the cost of online goods, which is where most people, as a means by which most people are getting their products these days, it's all going up across the board. So there's another way to think about it is to examine one single product. Bullfrog Spa's M9 hot tub requires 1,850 separate parts. Supply chain disruptions have pushed manufacturing time from 6 weeks to 6 months. So this is huge. So this has created massive backlog of orders, massive demand, reduced supply, and all of this is a perfect storm for inflation. There's no industry that's unaffected. And then gets into why there's no easy fix. It says there's no easy way to fix our supply chain problems. Consumer demand is only going to increase through the holiday season and beyond. And that's why inflation isn't going away anytime soon. Corporate executives, who in many ways will determine whether prices keep rising at a fast clip, are already warning that all of these challenges are going to continue into 2022 at the earliest. Some say the problems will extend into 2023 as well. So all of this is to say that we should be getting used to higher prices, and that's the new normal. So the question becomes, how do you manage your finances in a rising inflation environment or rising prices environment and an inflationary environment? Well, we draw it from an article from CNBC. They interviewed billionaire hedge fund manager Paul Tudor Jones, famous for predicting the 1987 stock market crash and actually profiting from it. He says inflation's here to stay. It says it poses a major threat to the U.S. markets and economy. You may recall from a few months ago when I interviewed Maya McGinnis, president of the Committee for Responsible Federal Budget. She talks about, hey, inflation is something that can absolutely devastate a country, particularly hyperinflation. Hyperinflation can devastate an economy more than a war, more than a natural disaster. It can absolutely flatten an economy. We're not talking about hyperinflation yet. We're talking about inflation, but it can be devastating for people's pocketbooks, for economies, for markets. He says, I think it's, to me, the number one issue facing Main Street investors is inflation. And it's pretty clear to me that inflation is not transitory, meaning it's not short term. It's here to stay. It's probably the single biggest threat to certainly financial markets, and I think to society just in general. And then he gets into why we're experiencing inflation. He says it's not just a supply and demand issue. He gets into the monetary stimulus. He says the trillions of dollars, fiscal and monetary stimulus is the impetus for inflation to run hotter for longer. To rescue the economy from the COVID-19 pandemic, the Federal Reserve has added more than $4 trillion to its balance sheet through its open-ended quantitative easing program, while the U.S. government has unleashed over $5 trillion in fiscal stimulus. So, of course, this gets back to the idea of printing money. And, of course, I love to rail on modern monetary theory. Modern monetary theory says that if you print money, there are no deleterious effects. You can print money with impunity. It will not result in increased inflation because it's going to grow the pie for everybody. Well, this billionaire hedge fund manager is saying otherwise. He's saying that it's been precisely the printing of money that's creating this inflation and will continue to create inflation over the mid to long term. It says inflation can be much worse than what we fear. We have the demand side of the equation, and that is $3.5 trillion greater than what it normally would have just sitting in liquid deposits. They can go into stocks or crypto or real estate or be consumed. So that's a huge amount of dry powder just sitting, waiting to be utilized at some point, which is why inflation is not going away. So in other words, we've got all this additional money created by the Fed sitting on the sidelines, waiting to be sort of injected into the economy. And when it gets injected into the economy, you've got more dollars chasing fewer goods. And when you have more dollars chasing fewer goods, that of course drives prices up. And then he gets into the types of investments that you want to keep away from in a rising inflation or an inflationary environment, rising price environment. He says you don't want to own fixed income. You do not want to hold that whatsoever, because what they're saying, what they're telling you by their actions is that they're going to be slow and late to fight inflation. And somewhere down the road, someone will have to come in and put the hammer down. Says still, the legendary investor didn't sound too dire about stocks, saying they could be a decent bet amid persistent inflation. Equities are interesting, he says, certainly in an inflationary world. They are much better bet than fixed income. All right, so let's get into the power of zero retirement planning worldview. How do you address all these inflation concerns within the power of zero context, within the power of zero worldview? Well, number one, we know that as you approach retirement, you want to make sure that you have your lifestyle expenses covered with guaranteed lifetime income. Remember, the number one threat facing your retirement is longevity risk, the likelihood that you will run out of money before you run out of life. You need your money to last through life expectancy. Now, if you have guaranteed lifetime income, it has to be inflation adjusted. So, for example, if you have a pension, there's a good chance it's inflation adjusted. It's got a cost of living adjustment to it, or what we call a COLA. We know that Social Security is also inflation adjusted. In fact, they just issued the inflation index for 2022, and it's on the order of 6%. Hasn't been that high in 20 years, by the way. And by the way, if your pension and or your Social Security aren't enough to cover your lifestyle needs in an inflation adjusted way, then you may need to avail yourself of an annuity. In other words, whatever your lifestyle shortfall is, in other words, whatever the difference is between what your lifestyle needs are and what your annuity and or Social Security provides for, that's your living expense shortfall. And one of the best ways to cover that shortfall is by way of an annuity. In other words, you're offloading longevity risk to an insurance company that can manage it much better than you or I can. This can guarantee that you'll always have enough money to last you through life expectancy. But here's the rub. You got to be careful, because when it comes to protecting against inflation, you have to have the right flavor of annuity. We know that one of the most common types of annuities out there is what we call a single premium immediate annuity. These types of annuities are not generally adjusted to keep up with inflation, which can be absolutely deadly if you believe we're in an inflationary environment and inflation's here to stay. Think about it. At 6% inflation, your purchasing power gets chopped in half in just 12 short years. So I recommend the fixed index annuity, or FIA. With the FIA, you link the growth of your income to a stock market index. This allows you to grow your guaranteed lifetime income in such a way that you keep up with inflation. Now, what about the rest of your portfolio? We know that with the fixed index annuity, you're basically taking a chunk of your stock market portfolio, you're handing it over to an annuity company, and what they're giving you in exchange is a guarantee that you will receive income adjusted for inflation until the day that you die. What about the rest of your stock market portfolio that does not get earmarked for that fixed index annuity? Well, it's important that you continue to grow and compound those dollars in a fairly aggressive way, particularly if you're planning on keeping up with inflation. Remember, once your living expenses are covered, you now have a permission slip, as it were, to take more risk in the stock market. And that allows you to keep a pace with inflation. So the worst move you can take in a high inflation environment is to not continue to grow your assets. So I'm personally a big fan of continuing to grow your money in a high octane pedal to the metal portfolio. This helps you keep a pace with inflation and dramatically increases the likelihood that your money lasts as long as you do. And if you have a down year on the stock market, your basic needs are covered, which gives you the luxury of allowing your assets to recover. So in other words, if you are needing to draw money out of your stock market portfolio for discretionary needs, and we define those as aspirational needs, which might be, you send your grandkids to Disney World, or the more severe expenses, which would be these emergency type expenses, like you got a hole in the roof, or you got to replace your carburetor, or you got family troubles and you need to send some money off to a kid. These discretionary income needs are generally drawn from your stock market portfolio. In a down market, you don't necessarily want to take those dollars out of the stock market while it's down, because then it exposes you to sequence return risk. And that could send your stock market portfolio into a death spiral from which it never recovers. That's why it may be a good idea to have what we call an LIRP, a life insurance retirement plan. Remember, the money within your LIRP is growing safely and productively. Gives you a death benefit, which also doubles as long-term care. But the idea is that the cash is growing safely and productively. You have a guarantee that you'll never lose money, which means the LIRP is a great place from which to draw money for those discretionary expenses when in the year following a year when your stock market portfolio is down. If you really want to explore this concept in earnest, you can read my book, The Volatility Shield. It talks about how the LIRP can help extend the life of your stock market portfolio investments by allowing you to draw money out of your LIRP to pay for expenses, particularly those discretionary expenses, giving your stock market portfolio the opportunity to recover. So the LIRP is a great pot of money drawn if you have discretionary needs in the year following a down year in the stock market. All right, so that is the podcast for today. Again, if you need some help trying to navigate all of these different issues, particularly how to protect your portfolio against inflation, how to protect your portfolio against the risk of running out of money before you run out of life, and how to protect yourself against long-term care risk, how to protect yourself against tax rate risk. These are all things that are contemplated in the Power Zero worldview. If you need help with all of these, head over to davidmcknight.com. Happy to refer you to a member of our elite POZ advisor group, among the very best tax-free retirement specialists in the nation. And if you're a Power Zero, or if you're an advisor and want to adopt the Power Zero worldview, head over to powerzero.com. Opt into the free video series. At any point during that video series, you can sign up for a phone call to chat with us. Again, a follow on Twitter would be appreciated. It's at McKnight & Co, at McKnight & Co. And would love a review for our podcast, our books, our movie online. That helps quite a bit. Thanks so much. We will look forward to chatting with you same time next week.